On Friday, February 21st, 2025, the market had a relatively large drop. There are usually signs that this type of price action is likely to occur. We are going to take a look at the signs and use these as an example of what to avoid in the future for why you don't want to buy the dip on days like Friday. This is the SPX on the 15-minute time frame. The exact drop was over 100 points from the time the market opened to the time the market closed. This is a proprietary graph created at Quant Trading app and sent to the Trade Engine's Discord channel. The Trade Engine does a ton of advanced options calculations, and then it generates this screenshot plotting these important levels on this chart so we can see next to price action. I'm going to play the video, which is just a collection of all the stills from Friday's Trade Engine, and it is showing us in real time as price action was moving every updated calculation to these levels. If we pause here for a second, the concept of an expected move is something that is important for traders. It is calculated from the options markets. What the Quant Trading app or QTA Trade Engine is doing is calculating the expected move in real time, and at every interval in which it sends out this graph, we have an idea of what the current expected move is for price action. On a day like Friday, where the market is selling off, it might appear as if it's selling off aggressively. However, this type of selling is actually a controlled selling. At no point until we reached a certain time later in the day did it actually hit the expected move. This is where you will see price action usually stall out or reverse. To a trader unaware of an expected move, this might seem as if the market is crashing. However, what the options market is telling us is that everything is going relatively according to plan. As we can see here, at no point do we touch this zone right here. This is the current expected move, and it's going to move with price action. As the day progresses, the expected move is going to become narrower and narrower as there is less time in the day. But as you guys can see here, this is what we consider controlled selling. There's nothing saying the market is oversold from an options market expected move standpoint. The expected move is also something that is, for the most part, forward looking. Unlike your traditional retail indicator like an RSI or a MACD or any other out-of-the-box indicator, they are looking at previous price action, they are looking at maybe previous volume, and they are reflecting what they see on your charting platform, sometimes at the bottom of your chart like the RSI and the MACD. But when you're using anything based on the options market, if you're looking at implied volatility or you're looking at something based on an expected move, it is more of an advanced indication of what's likely to happen. The implied volatility is telling you what is implied and what the options market is pricing in. So let's just say your favorite stock, ABC, has earnings coming up. You might hear in the news that the expected move is 20 points. That's letting you know that the options market is pricing in that stock, ABC, is expected to go up or down 20 points. That is what the options market is pricing in. The same thing applies every single minute of the trading day. The options markets, along with the Greeks, are constantly being recalculated, and they are creating expected moves on smaller intervals. What this is showing us here at this moment, this was the first time on Friday where the market actually made a drop larger than what the expected move was. That is what this graph is telling us, and it makes it very easy to see the price history of the day in relation to what the expected move was at each current timestamp of this chart. On Friday afternoon, just before I hopped into a meeting, I made sure to pop on very quickly to just issue out this fair warning for those of you guys in the gold section of Quant Trading App's Discord. Just a fair warning about today. This selling pressure has been controlled, and at no point was it oversold from an expected move viewpoint, as the SPX has not sold off aggressively yet to touch the expected move zone. These are the types of moves that can be more alarming and not the ones to take a counter trend intraday trade on. What I was pointing out to you guys here is this: at no point did the markets drop down to this red dashed line here. Even though 60/30 was a key strike, we were in a net negative GEX environment. There was a steady downtrend all day. Be careful with any bullish trades. I know some of you guys are reversal traders. I know some of you guys are counter trend traders. And just because this green candle showed up right here, there was not enough of a reason yet to take a counter trend trade. It wasn't until this candle right here. So this is what I'm referring to. I was on mic on Friday. We did a relatively lengthy afternoon live session here to close out the day, as well as after the market close. But this is what I was referring to you guys right here. This is that first touch of when the SPX was technically oversold from an expected move standpoint. So what do we expect when the market hits 60/20? This is where you can expect it to consolidate or at least stop selling off as aggressively. You can expect it to be choppy around here until there's clear signs of either a continuation in the trend or a reversal. If you trade 0 DTE spreads, this is generally where you can get at least a 60-minute time decay on an iron condor or maybe an iron butterfly. This is usually when I might consider running something like a put credit spread if I see any other additional signs of confirmation. The iron butterfly and the iron condor are my preferred strategies if I'm expecting to hold the trade for about an hour. As we continue to play out the tape right here, we can see we come down to this key level right here. If we continue to play the tape, we can see market dips, and then this is where pay attention to the nature of these candlesticks. They start becoming green, a little choppy here. There was a lapse in the calculation, so this graph was not generated at the time. And then but the point of what I'm trying to show here is look at the nature of these candlesticks. Look at where that first change happened. It happened after this drop right here, as the market sold off past what the expected move was for said time. We got choppy price action. It won't always play out this way, but after almost a full day of just straight selling, this extended move, as some traders might call an impulsive move or an explosive move, whatever you call it, this is where you can expect there to be some consolidation. And look at the nature of the candlesticks that started to form here. We got doji candles, multiple doji candles. This is great for theta-based traders. For directional traders looking for a reversal trade, you're going to want to look for some additional confluences. If you think the market is going to go higher, selling a put credit spread in a case like this is a little bit easier because you don't need the markets to bounce. You can just let it be choppy. Now let's rewind back to the previous day, and let's just say you are terrible at reading price action. In my previous video, there's actually a chapter on the break and retest in which we were talking about the price action that happened here. The reason I'm calling that out is because of the nature of these candlesticks here. Look at the next time we had a long wicked candle. It happened just as price action came back to this zone. Then price broke down on Friday and it retested this zone, and we can see the wicks coming off of this key area of 690. It's a zone around 690. But even before that, context is important. How can a trader use this previous day's information to think that the following day we might see some sort of a large move? In this case, up or down. We know it ended up being a large down day with a controlled selling. Nothing was too crazy. This is an edge that I like to use. So a couple weeks ago, I took a trade like this, but I shared it at the start of the week. I said next time it's Wednesday and the SPY is still hovering around the gamma flip, here's a trade idea for you. So if we click this here, this is what's called a strangle. In other words, I bought a call, bought a put. I'm not picking a direction. I'm just thinking the market is going to make a big move. The reason I'm thinking the market is going to make a big move is because it has been multiple days of consolidation around a key gamma strike. My expectation is that on Thursday or Friday, we will see a large move. There is enough data supporting that volatility has increased, or at least the range in the SPX's price action has increased on Thursdays and Fridays. And my expectations are increased exponentially if we are still around a key gamma strike. So this week here, as a joke, again, within the quant trading app Discord, right here, I said, guess what I'm thinking about swinging? So now this is the 20th, just after I ran a similar trade the previous week. This was price action here, consolidating around a key gamma strike. In this case here is 610 on the SPX, and it is now Thursday. So the market has gone nowhere for essentially 4 days. The expectation is that on Friday, we are going to see a large move. My expectation or threshold is generally within 3 days. It doesn't always happen exactly the day right after. In this case here, it was an excellent bonus. This is the trade here. I trade the ES option. So in this case here, I bought a 6,200 call. and I bought a 60-50 put. I went 11 DTE because I was expecting to hold it over the weekend in case the move did not happen on Friday. So this was on Thursday, and then as you guys already know what happened on Friday, we had this massive drop. This was a case here in which I used as my exit as the market dropped down to this previous week's point of control. I took that as the exit, and obviously I cried at the end of the day. My exit was around 16%, but at power hour on Friday, the trade at one point I think had hit over 100%. By the time I took the screenshot, it was up over 94%, as the SPX did end up selling off to the put strike that I was holding. So I started this video with something advanced like the options expected move at these intervals throughout the day. But the information from the day prior actually led to the thesis that this is already not the type of day in which you want to take a counter trend trade. It's likely going to be a trending day because of the fact that the market had consolidated. From consolidation comes expansion. Next, we had the breakdown of a significant level or a significant zone. This is letting us know the direction. Early in the day, we didn't know that the market was going to drop all the way down as there weren't enough signs or clues. It's not until price breaks down below demand or price breaks down below a support level do we then know who is winning the day. You also generally don't want to try and buy the dip when all of the major indexes are heading in the same direction. The same momentum on the Nasdaq was down, the same momentum on the S&P 500 was down. At the same time, the VIX was exploding, which is not good. It means implied volatility is increasing. And then you also don't want to buy when the Russell 2000 is also going down. These are the three major ETFs right here to have on your watch list. You can use the SPY, SPX, it doesn't matter. So we have the Nasdaq, the S&P 500, and the Russell 2000. If all three of these are trending in the same direction, that's also not a good sign to try to take a counter trend trade, especially if the VIX is going up. Lastly, we have gamma exposure. This is the SPX's gamma exposure on Friday. This is the 0 DTE, and we can see a lot of red here. The red means we are in a net negative gamma environment. So to start the day pre-market, we were not, and then as the market opens, the market was just around the point in which we started entering all of this negative gamma. The moment we enter this negative gamma territory, quant trading app starts creating these levels as red, and that's letting us know as a quick visual clue, hey, the market is now in a net negative gamma environment, which means expect more volatility. Looking at this chart right now, this is not a good sign. If the SPX is here and we see all of this net negative gamma down here, we see a big negative gamma bar here, we see some big negative gamma, some big negative gamma. This is generally not a good sign. If 60.90 does not hold, the market is going to want to head towards the next highest net negative gamma strikes, especially if implied volatility is increasing. If implied volatility was decreasing, we can say that the opposite would be true. We would expect the market to head back up to at least this area of neutral gamma exposure, or this high positive gamma exposure up here. There's also a lot of put volume. That's what this orange or levels in the back is telling us. This is all the volume coming in at these strike prices. Traders were speculating at this 60.50 strike price very early in the trading session. This is 10 a.m. Eastern time. We are seeing clues that this is not the type of day in which you want to be a bull. Look at as the negative gamma is growing throughout the day. So actually, if we click this here and we just click through this, you guys can see the market's dropped now to this strike here. This is around 10:30 a.m. Eastern time. Let's continue to click around. We're now around 60.75. Look what happened to the 60.50 strike. As we continue to go right along, it bounces back up. It's chopping, it's chopping. Now it breaks down below 60.75. The absolute gamma strike is now at 60.50. This is going to be calling price action at this point. We're now at 650. It means the traders that were speculating early in the day at the 650 strike are being rewarded. We can still see there's a lot of negative gamma around this chart. However, just based on the expected move, we know this is not a capitulation type of drop yet. There's still enough reasons to think we can go lower. In this case here, we did end up going low. Let's just rewind back. So 60.50 broke. I skipped forward too fast. I went back. So now I'm going to go forward so you guys can follow clearly. Now we dropped from that break of 650. The market drops down to 60.30. And then in unexpected fashion, 60.30 breaks and the market drops down to this 60.20 area. The expectation at this point is that 6,000 would hold as the market is going to close. There's not that much time left in the trading session. So the expectation would be 6,000 would be the last line of defense. Now the negative gamma starts evaporating from the markets as it's power hour. This is a 0 DTE gamma exposure profile, so there's not that much time left in the day, so it does chop around and consolidate around here, as we took note of on the chart again here. This was that move in which we first dropped down, but it did not really go much further past 60.20. For purposes of this video, the indication that we don't want to buy the dip too prematurely is because of all of this negative gamma. We have the highest negative gamma strikes below where the current SPX is. This is the highest one, but we know that this is a clump of a lot of negative gamma right here. So price has a high likelihood of going towards this area. There's also a lot of negative gamma below this area, which is a red flag. And not to mention, at the start of the week, when we do our gamma exposure levels to start the week, we were already aware of where the gamma flip was, but we also knew where the highest negative gamma was on the SPY to start the week. Once we entered this negative gamma territory, that is below the G flip strike. Once we are below this, this is where all the negative gamma is residing. This was a special week also because at the start of the week, this is what I share here. So these are the GEX key strikes marked off for this week. So this is the 8th week of the year. This is the levels here again. Before the market has any price action, we already know this is a huge zone of low net GEX between 609 and 600. This is 609 and this is 600. So between 609 and 600 in this range, there's low net negative gamma. This is where the markets can move pretty freely, as there's not a lot of these positive gamma nodes in this area. There's not a lot of high gamma nodes, so it will move a little bit more aggressively, especially if it is in net negative gamma territory. This is the profile 5 minutes after the market opens, so we could always go back and review this. And this is what I'm referring to here. This is a low profile. It's pretty thin up until we get to 600. If 610 breaks, 609 down to 600 has a low net gamma profile. This is our gamma flip at 608. If we are below 608, we are in net negative gamma territory. And this is 5 minutes into the start of the week on Tuesday because the market was closed on Monday. So before all of this happens at the start of the week, we know in this area here, the markets can move pretty freely. We also know this is net negative gamma territory. We also know if the market has consolidated 1, 2, 3, 4 days around a key gamma strike, it is likely to make a large move. We also know if it is on a Thursday, the market has been making outsized moves on Fridays. If this was a 5-day week and the market was opened on Monday, this would have been Wednesday's price action. The expectation would have been that the market would have made either a large move on Thursday or Friday of that week. But because it was just a 1, 2, 3, 4-day week, it meant that on Thursday, the move came even sooner or faster as there was only 1 day left in the week. If this did not happen on Friday, the expectation would have been to start the week tomorrow on Monday, we would have had some sort of outsized move. It is not as common that it happens on a Monday. It is more likely to happen on a Thursday or Friday. We also know that throughout the day, the selling pressure was relatively controlled from an options market standpoint until we got down to this level. There's so much more context and a lot of nuance around this, but hopefully in this video, I was able to show you guys some price action, a fact based on data around Thursdays and Fridays, using the expected move, and gamma exposure all packed into one video. And these are all things that we knew from the day before, earlier in the week, as well as even the zones to be aware of from last week's price action from a video in which I did last week. If you're terrible at picking direction, at least this can help you time things better on when to open up a strangle or a straddle, which is the trade in which I did. I was pretty much saying the market is going to make a big move in any direction because on Thursday, I was not sure that it was going to be down. I was not convinced yet until we broke down below this area here. That's where there was conviction that the selling pressure would continue down. But on Thursday, there was no way, at least for myself, to know at that point that we were going to be down this much. I just had conviction that we were going to make a big move in any direction. And then on Friday, once we got confirmation of the breakdown here, there was conviction that we would continue selling off to down here. If you're new to this YouTube channel, subscribe, leave a comment down below, like it if you learned something. Thanks for watching. I'll catch you on the next one.